So the topic of today's webinar is the evolution of the SME credit risk management. My name is Olena Gryniuk. I'm the CE director at the SME Banking Club, and I will host today's webinar. And I'm joined today by Tim Mush, who is the Vice President for the EMEA region at nCino, which is a digital SME lending solution provider. And they did recently a survey, a study on the topic of the evolution of credit risk management, and which he will present right now. And also, I'm glad to be joined by Julia Vernekinen, Chief Operation Officer at the Capital Box, which is fintech. It's a digital SME lender present in 5 countries, in Lithuania, Denmark, Finland, Sweden, and the Netherlands. And we will discuss this topic with Julia after Tim's presentation. So welcome. Let's start the webinar. We plan to have it 45 minutes. We will send the recording and the presentation afterwards. And if we will not be answer some of your questions, then we will try to answer them by the emails. All right, so let's start. Let's go to the topic. Tim, if you can start the presentation, please start, and we will go with it.
All right, then I'm going to start. I'm sorry, I'm flying blind here. I can't hear or see anything, but I can flip the slides, and that's the most important at this stage. So thanks for listening to us today in this webinar. We'll go quickly. Obviously, we've done the intros, I assume, and we'll just quickly go through what nCino can do and the reason we are here today. But in short, nCino is a loan origination provider, and we've been working in the commercial small business consumer mortgage space for the last 15 years. And we are currently expanding quite strongly in continental Europe and Central Europe. And so we are essentially going today to present some of the conclusions. When we are doing go-to-market, we are also trying to analyze trends and not just to provide solutions blindly, but we are also adapting our solution based on the research we're doing. And today's example is an example of research we're doing. We started with credit risk because that's where most of the challenges that our customers or prospects that we work with are facing, but we also obviously are going to follow that up with account opening and onboarding and other problematics within the origination space. We've just opened last week we launched a couple of weeks ago in our big user conference a new research center based in the US. So the first studies that we're going to do are obviously going to be about US based accounts, and we had a very interesting study launched last week about the stickiness of deposits. But we are in the future going to roll out also this type of researches to the rest of Europe. So if we look and look a bit at the study we've done and the research we've done around credit risk in particular, we've interrogated senior executive within IT and obviously credit risk and business banking in 12 different countries. So it's very much a qualitative study, right? So it's an empirical study, but the volume is large enough for us to be able to take out some trends and adapt our messaging and our R&D to some of the responses we got. to identify some challenges and investment priorities, which for us as a provider is obviously what interests us. It is also important to see that depending on regions, you will have different level of advancement, and you will have different level of understanding and of maturity. But overall, we managed to find some interesting interesting trends, which made us quite confident about some of the results we're presenting today. Typically, and I know I've seen a bit of the profiles of the people attending here. We don't go much in details about model building and but what we really talk about is the assessment infrastructure or workflow overall, and where the bank sits and how they are working with data models and overall, I would say, approval workflows within SME all the way up to large corporate lending. We've kept retail lending out for now, but a lot of those trends also apply to the more complex loans within retail banking. So the first part here, what we were able to identify is typically three types of stages in how those our counterparties within the banking world or the neobanks are considering themselves. So there are still a number, and quite large number actually, who are traditional, who are doing a lot of manual assessment, spreadsheet analysis from especially financial analysis, where most of the interaction with their customers is done via paper or internally. Julia, you'll be pleased to know that I can see you now, and Olena as well, but I still can't hear you. So we're making progress. But anyway, so we are, so there's still a number of banks that are in that traditional space, and actually are trying to make the loop directly to the advanced part. So they're moving from traditional to advanced, and they're going to skip the part in the middle, which is modern, and that modern part typically was put in place around post GFC 2008 2012 with IRB and Basel II and the IRB advanced models, where most of the especially the largest bank were starting to get data into the decision making, a lot more automated workflows, especially for the lower portfolios. They got much better in the collection of data and putting some controls in the workflow, like essentially putting a number of system-based workflows with quite advanced audit rights to be able to document histories of rejections and approvals of credits. And the advanced part, which we are going to identify a bit what type of profiles are advanced, but typically you would find in the advanced the banks who don't have any legacy, who are starting with a white paper and say, if I was a bank tomorrow, what would I be? And they are directly using the latest technology to try to get into real-time access to data, trying to find other alternative sources of data that are not necessarily just balance sheets or profit and loss, but directly are looking into transaction-based and cash flow-based models, and where they have already segmented their customers in a very granular way, also thanks to machine learning, and who are already implementing some of those advanced AI technologies. And I think, Olena, at this stage you had a question for Julia, so maybe our audience could benefit from that. No, it's not this stage. It's the next one. Okay. Sorry. I forgot to flip some of the slides. Yeah, so I was on the slides here about the traditional, modern, and advanced. Now, when we were asking banks, where or those leaders, what level of your organization, what maturity do you think you are? Obviously, a lot of banks are thinking that they are in the middle of a process. A lot of those neobanks who are established and are fighting for market share, they think, well, actually, we are pretty complete on our infrastructure, and a lot of those traditional banks are saying that they are at the early stage. And as I said, it's so early stage transformation banks who immediately want to go into the upper part of the advanced and to complete. And there's quite some large projects and investment done there. We see little banks who are just incrementally going to go from traditional to and go to the crawl, walk, run. I think there's a lot who are saying, okay, well, if we're going to transform, AI is actually a big ignition or initiator of those programs. The data landscape they have is very siloed, and so a lot are actually going to move from early stage to complete and spend quite a bit of resources on that. And what actually was surprising is that a quarter of those institutions aren't confident with their current process. So typically, we would locate them around the early stage, early advanced stage, where they're saying, we're looking at our dashboards once a month, and there's no real time early warning indicators and things like that. So they have seen better and they're striving for better. And so there is that's it shows progress and it shows that people have done a diagnosis of where they sit and where they should be. But there's a lot of program work going on right now.
I if we can stop here, and I can ask.
And in our survey, I think the one that comes all the time is data quality, and how much time do we spend working on data, and it's all over the place, and we have it can be stored into different ledgers, different models, risk assessment depending on the population, and so there's no real consistency there. Olena, you wanted me to pause for a while?
Yes. If we can stop actually on this two previous slides, and if I can start engaging you in this discussion. So, as a capital box, where do you see your company here on the credit risk stage? And have you started from a traditional, or have you started from a modern maybe stages once, as you are a digital, purely digital SME lender? How do you see yourself here, and does it differ in different countries which you are present?
Hello, everybody. Thanks for joining. So, talking about the capital box, of course, now we're more on partially advanced mode, right? We are more or less on the first two parts. We're still working on the real-time dashboard and information, and it is all connected with the customer loyalty part, how much information you can get from the customer real time. So it's also a point of importance here. When we started, we are quite of traditionally modern, I would say, because we never had the paper documentation. Spreadsheet analysis was quite in the very, very beginning. So we're doing the digital lending for the last 10 years, purely digital, actually. And it is more, we are focusing more on the modern part, or have been focusing on the modern part for quite a while. We have lots of automated workflows. We have lots of data centers getting the data, analyzing data, providing us insights, and doing credit scoring in real time. But as of the last couple of years, it is seen that this at the moment this is no longer enough, and we need to figure out and find the new ways of getting the data and working with it. So that's why we are in advanced mode, happily. But if to say from the next slide, are we complete? So we're definitely not. And I'm curious to know the names who said that they are complete, because for me, like, credit risk is never gonna be complete as a process, as you always need to evolve and you always need to work with the new processes. You need to find out the new sources, new solutions, and therefore this completeness is just like the state of today, but tomorrow you still need to be in the development mode again, because lots of things is happening. Lots of things are happening for the SMEs. It can be COVID, it can be war, it can be macroeconomic situation. So you always need to react fast. And though if you say that you are complete while the new solutions are coming up, you're probably quite behind already.
Mm-hmm. Yeah, I agree with you. And Timus, you are back with the sound, I guess, yes? What's your feeling, or maybe you have the data on that? What's the distribution in the European countries between the banks with traditional, modern, and maybe advanced level of credit risk?
It's not really on the, so geographically, typically Nordics and Netherlands and would be quite advanced. But they've started, they're surprisingly, a lot of them are in that modern part, right? They're not in the advanced. They were the first in the modern part, but then they are stuck there with some some legacy technology. But I would make a difference actually with the banks who have a big heavy bag of legacy and technical debt, and the ones who have who are lucky enough to start from scratch. And they, as I said, the advanced ones are the ones who basically could start with a blank sheet of paper and say, if I was a bank and if I have funding and capital on one side and customers on the others, what would I put in the middle? And they are, some have typically said, we want to be a human-led relationship-based bank, but all the back office and middle office will be fully automated and we'll spend more time on relationships. Some have actually skipped the whole human part, and they're just it's just apps with engines in the middle. But it's typically smaller, advanced, smaller neobanks that are in that space. The large ones are currently in actually most of them are still in the modern part. They say that they are data driven, but actually they're never fully automated. There's been quite a bit of work done in the largest banks for the SME approval. So there, yes, you can see. Again, I was in Australia a couple of years back, and one bank came up with BizExpress, and then another bank came back with GoBiz, and now everybody is approving loans in 24 hours with all the things in the middle of automated. But it's actually when it comes to mid-corp, large corporate, that it's still very manual. While there's actually there that you probably could save the most in human labor.
From your experience, how long does it take to level up from traditional to modern and from modern to advanced?
Yeah.
How long does it take?
Well, it's you're at least in for, if you're going to, and we'll get to some of the challenges later.
Yes.
But it takes time, right? Because the challenges, and I think Julia mentioned that as well, is you need to find the right personnel, and they need to be aware of the new technologies, and they also need to be aware of the latest regulatory framework, and then you need to have you need to have your decisioning. You need to have like some top-down approach that says we want to be modern, but the main issue is the data part, right? And that's the answer to that question is how long is a piece of string. Depending on what you are starting from, and if you are if you have a very siloed data landscape where you need to have 15 extracts or 40 extracts from different systems in order to have a overall view for your second line or third line defense, then the program is going to be a lot longer.
Mm-hmm.
And it's actually quite often also related to migration from mainframe to more modern cloud-based platform, and that technology migration usually takes between 3 to 5 years.
Mm-hmm. Okay. So let's move forward.
Okay, let's see. So yeah, I was going back to the challenges that actually are the rock in the shoes, from when you travel from traditional to advanced. So as I was saying, a lot around data quality and management, and that's what our panel that we interrogated puts first, is saying, I can build a bricks and mortar and extract data from 70 different systems in order to have the view that I want, or I can start consolidating those systems and those manual processes. And sometimes we're even lucky if the data is in a system and not in some Excel spreadsheets all over. So it's also a process. The data part is a process and practice part as much as it is about technology. The second one is the regulatory compliance, as I mentioned. I think Julia, you mentioned that as well. There's new regulations coming up all the time, so you want to be when you're complete is because you are compliant with the regulation you have today, but what's coming next. And so if we take it in order, and I know it's going a bit beyond credit risk, but it started with for the same amount that you were lending in 2007, it's the first layer of regulation you had was Basel II and capital requirement calculation, and then you had your KYC, and you had to be careful about who you were doing business with, so you had to do another intermediate layer, and then you had ESG, making sure that you can calculate the impact of any euros you were going to lend. So that regulatory compliance just adds layers of extra data points for in your workflow. I mentioned also that the decision making and the vision about modernizing is as important as some of the underlying tech. And then the last part that they mentioned as a challenge was to find the right skilled personnel that understand both the new technologies and what's coming and what it can leverage, and are also able to apply that to a more traditional, credit risk, calculations, and where can we use those new technologies in the value chain of credit, and where do we stay away from them? How do we make the difference between automation and AI? It's not exactly the same, but so that has been also identified as a challenge by the people that we interrogated. Yeah.
Yeah. Let's discuss maybe further as well how to overcome those challenges, because this is the crucial thing, right?
Yeah. Exactly. So we like if we talk, I think we have some parts about data and in this part that was also quite interesting. Found this for us is we're like, how frequently can your bank get conduct a review of the portfolio? And sometimes it's actually regulatory driven. It's driven by how many times do I have to report to the regulator on my capital requirements, and therefore a lot has been geared around that rhythm as opposed to actual business usage of risk, so yeah. We're quite surprised to see that 65 can actually access it only monthly or even less frequently. And those who do it least frequently actually run into troubles with their regulators. One of the main issues that they have is always saying about the data. How do I know that what I'm, that I avoid typically the garbage in, garbage out, and how do I make sure that if I have clean data coming, well, and we can discuss what clean data means coming from customers. I think Julia, you have some remarks about as well. How do I make sure that the data I get is actually clean? But once I have the data and it's coming in from the different customers in my risk assessment, and it's coming in from different other data providers, how do I make sure that throughout the whole value chain, going through the models, going through the calculations, going through the reporting, it's I can trace it back to the original numbers. And I can justify, all the data transformation that happened during this process, and that's we find out also that the more manual the process, the more prone to error. It's a bit cliche what I'm saying here, but it's still the case, We had a quote here from a tier 1 bank in the UK. Where they're saying like you can typically have for one loan that is, or one customer that is populated into 15 different systems, you can have like so many different errors that make the reconciliation of the data very difficult.
And yeah, Julia, do you have a real-time access to the real-time data on all your markets of your presence? And do the clearance and action and infrastructure make it all for you as well in the credit decision-making process?
It's pretty much depend on what we're talking in regards of the data. Is it the real-time data on the customer level? So let's take in like the new reports on the customers. And of course, we are able to do so, but let's be honest, it's all cost us money. So unless you actually need it, unless you have a review process that you actually need to have it in detail, we're not doing it on whatever like the daily basics. Of course, we have like the monitoring, which gives us hints if something goes wrong, but it doesn't mean that we would review the full stack of information on, on the daily basics. So the costs matter, and I believe it matters for all the companies and not just ours. But from regards of the data integrity and having the different systems, so we combine the data, we humanize it, we combine it from different system, different sources. We have plenty of reports on a one customer level that we need to pull for the guarantors, for the companies, for the UBOs, so the different sources. So we try to make it visible where we have the automation in full in some markets. In some cases, still like the biggest cases are run manually with the manual review. Usually, like 3 million loan wouldn't be eligible for the automated decisioning and automated processing. So in some cases, we still have people to review and make the decisions. So in this regard, this is still, we're trying to make them as simple as possible to have this ability of information and see at the same time where where the triggers are. Not always an easy part, because even in these cases, yes, some manual information which we receive from a very different sources, even from the customer, it might end up in the Excel spreadsheets. Yes, for the bigger customer, it's still come up with, or the PDFs. So in this case, it is more difficult, but this is where the AI comes from, to scrape, to analyze, to summarize the information and bring it to the table onto the risk underwriters. So this is what we have. The data integrity is super important. And just reflecting on the issues that we have, or that the issues that companies are facing. So the faster you change your system to be modern, the better. Because we are still having the same system for the last 10 years, which works for us. But if we would constantly iterate on new systems, this wouldn't work. So these legacy parts we see from, having the PSD2 integration with different banks, it's obvious that some having these legacy systems because we are not constantly receiving the same stack of information, even from the same banks, because on the acquisition moment of the different banks and the mergers of the different banks, they haven't been combining the system. So it becomes very visible how banks are handling their infrastructure inside. So, and we see that they really struggle to have this combined approach, which would be beneficial not only for us as at some point like a small competition we still have with but it would be really, really beneficial for our SME customers, which are not having the financial solutions from the bank directly.
Okay. We have one question from Jose, but I suggest that I will read it since we discuss it after Dim's presentation, because I think we will discuss more about AI and automation, and then this will be the question to wrap up actually the session. So I suggest let's move forward.
Sure. Just to focus quickly on some of the where do banks invest in credit risk tech, and I will bit more specific on the value chain. So obviously this wouldn't be a presentation today if I wasn't mentioning AI, but I'll just make some I'll be careful about this part, right? So we see in our conclusions that obviously, and this was done in December, so obviously a lot has changed since, but at the pace that it goes, most of the use of AI is used at the entrance of the value chain. So how do I and also machine learning, actually more than AI, but it's how do I make sense of a lot of data coming in, and how do I automatically categorize data? And you even have a ton of providers in that space who are popping up and using PSD2 data and use AI to categorize data. But is how do I help the different risk analysts to categorize a large amount of data, and then AI is used at the back end then of the process. That's more specifically Gen AI to generate documents, offers, even credit memos, taking conclusions, presentation material that is using the data that has been put in the process. But where we don't see a lot of AI yet, we see the first experiments within our customer group and prospects is the use of AI for automatic decision. So the automation part exists, right? And it's again, it's heavily regulated in the decision making of credit risk. It's approved type of models, and this can be automated. Those are formulas and algorithms that can be used. But the actual use of AI decisioning is still something that is in test mode, and that is mainly, and probably will need a lot of time and parallel runs to go and say that the machine has taken a decision that is as good as the human, and the impact on our capital requirements has been negligible. So therefore, we can installate more AI in credit decision themselves. So it's what we see is mainly at the entrance of the funnel is increase in a lot of AI-driven models for classification and Gen AI then for the presentation. Now, AI without proper underlying data and underlying, what just 3 years ago we called big data, is not really a proper use case. And so there's a ton of AI projects that have failed just because the actual data pool was too narrow, or just the data quality wasn't there. So it's really the typical use cases we see would be in financial spreading is one. It's on onboarding. It's on typically also finding out who your customer is with ownership structures and so on. That's where we see a lot of categorization of and AI driven.
If I may, so for AI, it's as an example for us, it's not only the scoring itself or not the part of risk dependent just on the granting the loans, but it's also like the prevention of not granting those. So it's the part of the compliance as also differentiating the transaction even from the PSD2 information, like taking out the information on the cash transactions for the SMEs. We see that there are quite some customers or like potential customers who would like do the ATM transactions on the daily basis, right? So this is like putting again like some high risk flags, which at some point when customers are having lots of transactions would be really, really hard to tackle in any like automation way or the manual way. So like figuring out the fraud patterns that are also quite difficult to handle in the other direction. So AI-driven models can go exactly to the risk point of how to what is the risk score, is it like ABC whatsoever, but it's also getting us additional insight of the initial risk or the possibilities on the compliance topics.
Would you divide, or would you in generally divide the processes which are worth of automation without the application of AI or Gen AI, and the ones where AI is becoming a must-have? Both of you, Yulia and Tim, what do you think on that?
Like what do we say about the dividing? So we definitely need more automation than more harmonization, right? We need to have the same approach on the data, which when we to take it manually, it's a huge issue because we still have biases. If you have the companies who have lots of trying to make the like optimization and efficiency for the companies. Like when we started, we had underwriters in one countries when we figured out that AI just simply doesn't work because you need to know the like local content as well. So it makes the difference, what are you going, if you simply automate the stuff without thinking, it doesn't work. When you apply AI without, with the very limited thinking, without a holistic view, it doesn't work. So in any cases, you need to figure out the balance between having both ways, and also we need to have the controlling tools on both like AI and automation, and see is our solution that we want and we implemented, does those work? Are those work efficiently enough? Do we see the increase, decrease, and what additional data we can gather and insights can we do from it? Because there are like lots of patterns that we are missing because we have never seen those, we have never get those insight before. But there is of course that huge risk of the additional like biases if you train your data on the simply the previous models and the previous data. It is not always the best picture that you want to achieve, because it will be quite limited.
Yeah. And how do you do it? Do you use synthetic data for that purpose, or what's the way out?
No, at the moment not yet. So we're still trying to review all of this in a more like structural, strategic manner on getting the insight out of it. So we haven't used this synthetic data yet, but this is something that we are looking forward. And what actually would definitely help is the pool of the data that not synthetic, that you could purchase from outside, and which is not something in place, but which would definitely be much beneficial, even anonymized data. So it's really dependent on your pool of customers that you have. It's dependent on the loyalty of your customers. So there are lots of ingredients in this recipe. So it's it's more and more interesting, but it's more challenges are also there. How not to mess up with what you have created, and how to read the data carefully and accurately.
Yeah. Tim, yeah, the mic is back to you.
Yeah, thanks. I'll just have actually talking about AI. We have a couple of more slides and research we've done around this. So typically, of course, we had to go to market and asking what you're doing about AI, and there's 21% who have heard about it but not really interested. There's 30%, as I mentioned, who are piloting it, and then they figure out that actually, well, our data is not there at all, and so we cannot work for it, like make it work. One case we had, for example, was can I help my bankers interpret credit policies? And so they made a little ChatGPT like engine, and typically the results were inconclusive because the policies were all over the place and were varying for each and every product, so they had to work on that. There's quite interestingly among the largest banks, it's the ones with the lowest cost income ratio that are implementing AI. So we find that a correlation there, which is quite interesting, because you would think that those are probably the ones that are the least driven by streamlining even more their process, but actually they still consider that increasing income is difficult enough that they have a big focus on costs, and implementing AI allows them to reduce those costs and saving some FTEs along the create process. And then there's 20%, again going back to the ones that have started with a fresh new infrastructure that is cloud-based, where most of the data already flows quite nicely through the process, who are extensively using it. And they're using it to serve their customers with chatbots, and they're using it to approve. They're using it to ingest a lot of data and categorize the data, and of course they're using it. They're using it to in the fraud detection space. So on the three preferred AI use cases, fraud detection I just mentioned, loan underwriting. So it's all that human interaction that is being streamlined or focused more towards either relationships, either that human part is actually in some cases entirely removed. I will reassure everybody, it's mainly used for more relationship-based approach, and it's mainly used for having expensive bankers work on those relationships and those business case making, as opposed to go and type in a ton of data that a machine could do for them. And then the last part is about portfolio management and more proactive portfolio management. So it's first in be more reactive in identifying risk, and I think you mentioned earlier, Julia, that obviously the risk profiles are changing with all those macroeconomic events that are happening, and obviously actually AI is also an impact on a number of companies that are going to be downsizing. The other is also identify with portfolio management more quickly areas of areas to increase market share, and so going to market with faster than the competition. I think we have a question about how can do you see increase in the usage of advanced companies in the portfolio? I think speed is of the essence, and in the portfolio management space, we can quickly identify opportunities and or areas of development, of commercial development, and providing more products faster than the competition, even if you are more expensive. Sometimes the fact that you are more relevant faster will allow you to win market share. So those are the three main use cases we see in the underwriting space. In more in particular, that's what I mentioned earlier. It's ingesting a lot of data, removing manual interventions, and providing faster decisions and faster Gen AI driven offers or create memos. Yeah.
Mm-hmm.
Any questions on that, or does that
if you mentioned already, so I will turn to the Jose's question, but also add something from my side. That yes, can you comment the observed increase in SME loans approval rates when it's going or leveling up from the traditional to alternative scoring models? But I will add to the questions not only in the sense of the speed, right, but also do you think that moving to these advanced models which you showed makes banks, fintechs for sure, but banks also. Do you think it's that the banks, due to such change and shifting to the data-driven and automated risk models, can have more appetite for SME loans? Can they? Tim, what's your opinion on that?
Yeah, I mean it's a volume based. It's always a volume. It's volume versus value of those loans, right? And so if you are going to spend 56 days making a bespoke or providing a bespoke product for an exposure like a value of 300,000 euros, you're not going to be very profitable. And if that's 80% of your SME loans are in that space, then someone who comes in with a, we saw that in the Netherlands, for example, someone who comes in with a very maybe more expensive product, but where the decision is taken in 24 hours and the money is disbursed in 2 days max, that's where the SMEs are going to go. And those who have understood that are winning market share in entrepreneur market and in the SME market. The problem is how for those smaller players than neobanks is how do they retain those customers, because as soon as those customers start growing, their banking needs and products needs are more diversified, and that's typically when then they join back into the more traditional banks who have a larger offering of products. But typically in the lending space, at least, speed is of the essence. And if you take a quick decision because you're using transaction data and your model is robust and you can even use some invoices as collateral, then that's how those and we see that in every market we're in, that they are gaining market share in the entrepreneur space and in the SME space. And the larger banks are now saying, okay, we have spent the last 7 years reducing our decision process from 50 days to 15. And while we've done that, the neobanks are now, doing that in 1 day. So we need to spend another 7 years maybe to go from 15 to 1 day. Yeah, that's just not sustainable.
Mm-hmm. Let's move to the next question from Govinda, and which I think is also connected to the usage of the new models or another data sets to make the decision. So Govinda is reaching out from Nepal and asking whether you have any tools or frameworks available for assessing the potential credit risk of new SMEs aside from the traditional 5 Cs approach. And Julia, this is what you mentioned. If we don't have too much data on the SME credit history or any data because of manual processes on many markets, SMEs are underserved, so we don't have historical data much. Yeah. So which news, which data behavior, which we can analyze and which will be, make these decisions for SMEs possible.
So definitely, I believe the top notch at the moment is the revenue-based financing. When we are analyzing the data directly from ERPs with streamlined information without any hesitation and any delays, so which gives us straight away as much as information as we would never expect, a few years ago, to have the customer, payment behavior included into the financial figures. So revenue-based is one of the things which will be booming in the coming future. One of the issues of that is if we are working with SMEs. There is no like one system that all SMEs would use. So this is like a connection issue with ERP data that you need to have, but it's also, how do you again combine the information in the same way so you can analyze customer in the same manner, because in some ERPs you might have, a bunch of information, what are like 200 data points. In another one, you will have like 20 because it's a very small customer. So then you are not able to connect one-on-one and make decision, straight away. But this is still, something to definitely to focus on, to dig deeper and find the sweet spots. And like PSD2 data, of course, it's another source of the straight away analysis, because it also gives you like additional information, as mentioned also by the team, of like the categorization of data will give you quite enough information to make the first round of for the data analysis and risk assessment.
Mm-hmm. Mm-hmm. Yeah. All right, we have some. We can have several minutes to wrap up. So let's discuss how to overcome the challenges in the next slides, team.
Sure. I mean, the next slides are just some parting thoughts that we've seen through partner, but typically it always starts where do we want to go? So for large banks, it's breaking away from silo thinking and try to have a clear picture of the target state. I think that is actually the main challenge. It's saying, okay, if we're going to be automated and if we're going to go for a full AI-driven credit risk policy, what are the first? What is my target state? The other is, how much do we want to save? And that means also making the hard choices about looking at other examples of streamlining this process and how we finance this. Do we keep our pricing level of our loans or credits at a certain part? Do we already start taking some of the hit and win in market share before we part? But I think cost optimization is a very important aspect. Which platform do we put in our first line and second line defense? And how do we make sure that we expose the right models to the first line defense? And how do we make sure that we the first line goes after the desirable customers? Then the third part is obviously directly more in line with what type of model, how do what is my approach here? What type of model do I use? And then finally, at the end is how do I report back the efficiencies that I designed in number one, both to the management, but also to the regulator. Typically, regulators are going to get a lot more educated about AI in the decision process for credits and how we see them already starting to open up a bit. But typically, they will also require to have a lot of guardrails. Around those AI in the process.
Mm-hmm. All right, and maybe to wrap up, what would be the main message from both Tim and Yula from your side to our attendees, how actually to level up to the advanced model, whether this is more technology or actually people skills, new skills, AI skills, right, needed in the advanced credit decision-making process. What's the main message, or maybe some points that attendees should take into account when leveling up their risk management processes?
I believe it all starts with the customers that you want. So you definitely need to have your best customer persona to define, and then this is all comes after that, because if you do not know who you are trying to get and who you are trying to sell to, then this is an issue. And as soon as you have the persona, you also need to understand the background of this persona, so which ends up also in the enhancing the skills, not only the technological part or AI part, but also like taking a little bit more on psychological aspects. As working with SMEs, it's also bringing, it's one-man show at some point of time who can run millions. So for some people or some companies with 1-2 people, like the sickness or vacation would make a huge difference into the planning, not planning for the worst but planning for the best. So you need to look at this a little bit wider than not just on the figure level, but you also need to understand your personas and how do they work and what it is needed. And sometimes it is not just the data, you actually need to do this qualitative surveys, as Tim did. Thanks him for that. And actually to speak to your customers, to speak with partners, and see how to bring more value, because we are all here to bring more value for the customers and for the companies that we are in.
Right.
Sounds about right. Then I will just add it's start with data. Once you know your customers and once you know who you want to go after, start with data. It's a data-driven world now, and so everything that can be part of the process needs to be digitized in some way, and get it into a data format, and then you can start building behavioral models and AI and all those things. But it's right now for most of the banks we're talking to, it's all about data.
Yeah. All right. Thank you very much. Thank you very much, Tim. Thank you very much, Julia. Thank you very much, all our attendees, for staying till the very end. Thank you for sharing your experience, your study results, and see you next time. Thank you very much.
Thank you. Yep. Thanks.
Thank you. Bye-bye.
Thank you. Bye-bye.